In every financial crisis, there's a moment when the room goes quiet. Traders stop joking around. Screens that once felt familiar now seem foreign. The air itself feels heavier, as if the walls are just waiting for something to happen. But the first real sign of trouble never appears on CNBC, it's never in the bond market, and it's never in the dollar charts that people watch like a religion. It happens somewhere else entirely, somewhere that was never supposed to matter. It happens inside a digital corridor where capital moves when it no longer trusts the system that built it. And you can almost hear it, this slight, almost imperceptible shift, as Bitcoin begins to glow like a distant warning light. It doesn't announce its arrival with a dramatic spike. It simply becomes the place where nervous money starts to drift, the same way frightened animals move toward higher ground long before the first wave hits the shore. To most people, Bitcoin is just speculation, an ideology, or meaningless noise. But to the people who manage risk for a living, the quiet ones, the ones who see liquidity fractures long before the public even knows something is wrong, Bitcoin is something else entirely. It is the emergency exit door at the back of the financial theater, the one with no official sign, the one nobody talks about until the smoke begins to rise. You were never supposed to pay attention to that door, and the system was never supposed to need it. But modern finance isn't built to handle trust breaking all at once. It isn't built for silent capital flight. It isn't built for the kind of cross-border panic that bypasses banks, custodians, and clearinghouses. The entire system is built on one core assumption, that everything stays inside the structure, that every asset stays in its designated lane, that liquidity always follows the rules. But crisis liquidity doesn't follow rules. When sanctions are imposed overnight, when a crucial swap line fails, when a central bank freezes collateral over a geopolitical weekend, when a prime broker has a margin hole, it refuses to admit capital stops caring about rules, morals, narratives, or textbooks. It boils down to just two questions. Where can I still move? And where can I still exit? That is the precise moment Bitcoin stops being an investment narrative and becomes a mechanism. It transforms into an escape channel, moving silently beneath the official plumbing of global markets. The first people to notice are always the ones closest to the fracture. The market makers unable to roll their inventory, the offshore desks suddenly paying huge premiums for basic currency conversions, the cross-border funds seeing settlement delays that just don't make any sense. They feel the pressure building before the charts show anything. They see the hesitation in the market before the headlines are written. And when they start watching Bitcoin not to trade it, but to monitor it, you know that something deep inside the system is beginning to shift. Because Bitcoin has a strange, quiet habit. It absorbs the fear that traditional markets refuse to price in. Sometimes it happens slowly. Sometimes it happens violently. But it always happens at the exact moment when trust becomes a casualty. In this video, we're going to open the file the system never wanted you to see, the file that explains why Bitcoin consistently becomes the shadow. Liquidity route during sanctions banking freezes sovereign debt crises, settlement failures, and major cross-border shocks. This is not a story about ideology, speculation, or hope. It is a story about how capital behaves when it believes the official doors may be closing. Let's start with a simple idea: liquidity. In normal times, liquidity is everywhere. You can sell a stock, a bond, or a currency in a split second. But that liquidity is conditional. It relies on a complex web of trust between banks, clearinghouses, and central banks. What happens when that trust starts to fray? Let's take the example of sanctions. When a country is suddenly cut off from the global financial system, its citizens and businesses don't just stop needing to move money. They need to do it more than ever. But the official channels are now closed. The SWIFT system is off limits. Their bank accounts abroad might be frozen. Where does that money go? It doesn't just vanish. It seeks a new path, a path that operates outside the control of any single government or institution. This is where Bitcoin's first function as an escape channel becomes clear. It's a bearer asset that can be moved across borders without permission. It doesn't rely on a correspondent bank or a settlement agent. All it needs is an internet connection. We saw this play out in real time during various geopolitical events. When capital controls were imposed in certain countries, we saw a noticeable premium emerge for Bitcoin on local exchanges. People were willing to pay more for it because it represented a way out. It was a lifeline in a system that had locked its doors. But it's not just about sanctions. Think about banking crises. In 2023, we saw the collapse of several regional banks in the United States. For a few tense days, people with deposits above the insured limit were facing the real possibility of losing their money. The system, which was supposed to be the safest place for their capital, suddenly became the source of their risk. During that exact period, what did Bitcoin do? It didn't crash with the rest of the market. It rallied. It wasn't because people suddenly believed it was going to replace the dollar. It was because it represented an alternative system, a place to park capital that was not tied to the health of a specific bank or the promises of a specific government. It was a flight to safety, but not the traditional kind. It was a flight to a different kind of safety, the safety of self-custody and decentralized settlement. This brings us to a more hidden aspect of the financial system, the settlement layer. Most people think when they buy a stock, the transaction is instant. But behind the scenes, there's a complex process of clearing and settlement that can take days. This process relies on a chain of intermediaries, and each link in that chain is a potential point of failure. What happens when one of those links breaks? What if a major clearinghouse can't settle its trades because one of its members has defaulted? The entire system can seize up. This is what market makers and institutional traders fear most. Not a drop in price, but a failure of plumbing. They call it counterparty risk. The risk that the other side of your trade won't be able to pay up. In a systemic crisis, this risk becomes enormous. And once again, Bitcoin offers a different model. Bitcoin transactions are settled on the blockchain, and that settlement is final. There is no T+2 settlement window. There is no clearinghouse that can fail. The counterparty is the network itself. For a trader staring at a frozen settlement system, the ability to move value on a network that settles in minutes, not days, becomes incredibly valuable. It's not about replacing the entire system. It's about having a backup generator when the main power goes out. The people who see this first are not the analysts on TV. They are the traders on the front lines. They are the ones who manage the flow of capital across borders every single day. They notice when the cost of swapping one currency for another suddenly blows out for no apparent reason. They notice when it becomes difficult to find a counterparty for a routine derivative trade. These are the subtle cracks that appear before the earthquake. And when they see these cracks, they start looking for alternative routes. They start monitoring the price of Bitcoin not as an asset to speculate on, but as a barometer for systemic stress. They watch the premium on offshore exchanges. They track the flow of stablecoins, which often act as a bridge between the traditional financial system and the crypto world. For them, Bitcoin is a data point. It has a measure of fear that is uncaptured in the VIX or the credit default swap market. It's a measure of capital trying to escape. When trust in the official system is high, Bitcoin is just another risky asset. But when that trust begins to erode, its properties as a permissionless, censorship-resistant, non-sovereign bearer asset become incredibly important. It becomes a tool for capital preservation in a world where traditional safe havens are becoming less reliable. This leads us to the final and most crucial point. There is a moment in the cycle of a crisis when Bitcoin stops just reacting to panic and starts predicting it. Long before Bitcoin was just another ticker symbol on a stock exchange, before sophisticated hedge funds built algorithms to trade it, and even before Wall Street started using it as a weird but reliable thermometer for global stress, there was a much deeper story unfolding. This is a story most people missed because it grew in the shadows of geopolitical panic, banking crises, and silent capital flight. To truly understand why Bitcoin keeps becoming the escape route during modern financial instability, we have to go back to its earliest days. Back to a time when the world first ran into the limits of its traditional financial systems. Because Bitcoin's role today didn't come from technology, or ideology, or even speculation. It was born from the absence of trust inside the very architecture that global markets depend on. Its function as escape liquidity was forged in crisis, in those moments when the usual ways of moving money simply broke down. It all started quietly back in 2011 with capital flight from authoritarian states. Governments were restricting bank withdrawals to stop money from flooding out of the country. Bitcoin wasn't well known then, but it offered something no other asset could. The ability to move value across a border without needing permission from a bank, a central bank, or any clearing network. The first people to use it weren't tech idealists or financial dreamers. They were people in places where the financial system itself had turned against them. Then, in 2013, traders in Cyprus saw this firsthand. The government froze bank deposits and took a haircut from people's accounts to prevent a total collapse. Bitcoin volume didn't spike because people thought it was digital gold. It spiked because, for a brief, terrifying moment, it was the only door that couldn't be locked. In the years that followed, we saw the same pattern pop up again and again in Venezuela, Argentina, Nigeria, and parts of Eastern Europe. Currency controls, hyperinflation, and banking restrictions created an environment where capital was desperate for a way out, for any route that existed outside of failing domestic institutions. Each time, Bitcoin became the improvised solution. Not because it was perfect or stable or even safe, but because it was there. It was accessible, it couldn't be confiscated, and it worked when other systems were completely broken. By 2015 and 2016, something new started to happen. Bitcoin wasn't just showing up in distressed countries anymore. It started appearing in global markets whenever there were issues with payments, sanctions, or cross-border friction. When China tightened its capital controls in 2015, the price of Bitcoin on Chinese exchanges shot up way higher than the global price. This was early proof that Bitcoin was acting as a pressure valve for money trying to get around the official banking system. Around the same time, major global banks started getting nervous. They began cutting ties with smaller banks in regions they saw as high risk for money laundering or regulatory fines. The World Bank reported that between 2011 and 2019, these correspondent banking relationships dropped by over 20%. This meant that sending money to and from certain parts of the world became slower, more expensive, and sometimes nearly impossible. When the official pipes get narrower, informal systems naturally expand. And Bitcoin, operating on its permissionless network, quietly started picking up the transactions that traditional finance either delayed or flat out rejected. We tend to think financial stress always starts in big, headline-grabbing markets. But the truth is, it often begins with a tiny bit of friction in the smallest link of the global chain. A delayed payment, a new capital control rule, a sudden bank freeze, a new sanction. Each one of these little events pushed Bitcoin a little further into its unintended role as a shadow settlement network. Then came 2017. Most people remember it as the year of the cryptomania, the big speculative bubble. But something far more important was happening underneath. Bitcoin's trading volume suddenly started to correlate with geopolitical stress. When tensions with North Korea flared up in August 2017, Bitcoin surged, moving completely independently of other risk assets. When China banned ICOs in September, the trading volume didn't disappear. It just moved offshore. The asset was showing the world something strange. It could absorb demand even when traditional liquidity was running for the hills. These patterns weren't ideological. They were structural. Global investors were learning, some consciously and some not, that Bitcoin behaves differently when trust breaks down. And that made it valuable, not as a speculative bet, but as a backup system. That same year, capital flight from South Korea, partly driven by fears of war, pushed the local Bitcoin price, the kimchi premium, to double-digit percentages. Investors weren't mispricing Bitcoin. They were pricing geopolitical risk into an asset that could move even if their local banks froze, shut down, or slapped limits on withdrawals. For the first time, the world saw Bitcoin act as a parallel financial channel during a national security crisis. But the true historical turning point came in 2020 with the global pandemic. When markets crashed in March, something extraordinary happened. Bitcoin fell hard along with everything else, but then it recovered much faster than risk assets normally do during a systemic crisis. That recovery wasn't driven by memes or retail hype. It was driven by the fact that global capital needed new escape routes. Travel restrictions, border shutdowns, and fragmented banking created pressure points everywhere. Many countries imposed emergency banking measures, limiting cash withdrawals or tightening capital controls. And for the first time in its history, Bitcoin had enough global liquidity and infrastructure to serve not just individuals, but funds, family offices, and wealthy investors looking for flexibility across jurisdictions. This was the moment its identity as escape liquidity went from a niche story to a structural role. During this time, stablecoins also surged. But Bitcoin had one key advantage. It wasn't tied to any government, bank, or company that could be frozen or sanctioned. And then, 2022 gave us the clearest proof of all. The sanctions against Russia triggered an unprecedented wave of restrictions in the global financial system. SWIFT bans, frozen reserves, blocked banks. These were tools that hadn't been used on this scale since the Cold War. In that environment, Bitcoin's on-chain settlement became a form of emergency utility. Even though Russia as a state couldn't use Bitcoin to evade sanctions at a massive scale, individuals, businesses, and people in neighboring regions used it to bypass blocked banks. Transaction volume on peer-to-peer networks surged in countries all around the conflict zone. At the same time, ordinary Russians, not oligarchs, started using Bitcoin to move their family savings out of the reach of domestic capital controls. Western policymakers often underestimate this. Sanctions don't just affect governments. They affect civilians, families abroad, exporters, freelancers, and small businesses. When those groups lose access to the traditional financial rails, Bitcoin becomes a lifeline, not an ideological statement. It wasn't just an investment anymore. It had become the de facto escape mechanism for individuals caught between geopolitical powers. By 2023 and 2024, the pattern was undeniable. Every time a country announced capital controls, Bitcoin volume ticked up. Every time banks were hit by a crisis, like the 2023 collapses of Silicon Valley Bank, Signature Bank, and First Republic, Bitcoin rallied sharply right after. Not because bank failures are good for crypto, but because they reminded everyone that access to your own money is never guaranteed. At the same time, trade in distressed regions increasingly used Bitcoin as a temporary settlement layer when banking relationships were unstable. Nigerian trading firms used it to move value during currency shortages. Ukrainian civilians used it in the early months of the war to move donations and personal funds when the lines at local banks were hours long. Argentinians used it to sidestep hyperinflation and capital controls. And in Lebanon, Bitcoin became part of a survival strategy for families locked out of their own bank deposits after the entire sector imploded. These weren't speculative events. They were demonstrations of a core weakness in our global system. Official liquidity channels fail faster and more often than we think. Bitcoin's historical role didn't come from Silicon Valley slogans or Wall Street adoption. It emerged from the cracks in geopolitics, from banking failures, and from the slow, dawning realization that in a world of instant digital connection, your access to your money can be revoked in a flash. And because moving Bitcoin doesn't require anyone's permission, its utility during times of stress grew organically, without a central plan, without institutional approval, and without any government's blessing. The great irony is that Bitcoin never needed the world to trust it. It only needed the world's traditional systems to fail every now and then. And they did again and again, across different decades, on different continents, and for different reasons. This history-spanning bank freezes, sanctions, inflation crises, war, capital controls, and systemic liquidity shocks is the forgotten prequel to Bitcoin's role today. It explains why now, when global markets get tense, the earliest signals often appear not in bond markets, but in Bitcoin's strange, stubborn resilience. It has become the place capital goes when the traditional rails feel unreliable, the unintended, unplanned, but structurally inevitable escape valve for a world that didn't realize just how fragile its own financial architecture really was. For over a decade, the story about Bitcoin went something like this. When a crisis hits, people flock to it. It was seen as a speculative mirror reflecting the fear that had already rocked stocks, bonds, and currencies. But what if that story was backward? What if Bitcoin wasn't the echo of the crisis, but the first tremor? The real twist in Bitcoin's story isn't about its price, its technology, or even its controversy. It's about timing. The moment you realize Bitcoin doesn't react to crises, it anticipates them. For years, analysts dismissed its movements as noise. But a different story was hiding in the data, a story so subtle that most big institutions missed it entirely. Only those closest to the global flow of money started to notice something strange. Bitcoin often moves before traditional markets even admit there is a problem. Think about it. When sanctions are being drafted behind closed doors, Bitcoin volumes in the affected regions start to climb days before any official announcement. When a regional bank starts to wobble, Bitcoin's price often finds its footing while stock indices are still in free fall. When rumors of capital control start to whisper through a country, you can see it in the widening price gaps between crypto exchanges long before the local currency shows any sign of stress. These aren't just coincidences. They are signals bleeding through the surface of the global financial system. They reveal a truth that many aren't ready to hear. Bitcoin doesn't wait for the crisis to be declared on the evening news. It moves when the people on the inside, the ones on the ground, start to worry that the doors are about to slam shut. This complete reversal of timing changes everything. Once an asset starts moving ahead of the news, ahead of the official economic indicators, ahead of the fear gauges, it stops being just a speculative toy. It starts acting like a pressure gauge for the entire global system. The earliest clues appeared back in 2019. Bitcoin would suddenly spike in certain countries weeks before any public reports of local banking stress. Observers called it random retail speculation. They didn't see what was really happening. They didn't see the cross-border families, the offshore contractors, or the small business owners who sensed what was coming. They heard the whispers of new policies. They noticed their own banks behaving strangely. They were getting ready. Then, in 2020, the pattern became impossible to ignore. As the world fixated on the pandemic, Bitcoin's liquidity flows started shifting dramatically days ahead of each major lockdown announcement in different countries. In hindsight, it wasn't a mystery. The people closest to those decisions, or the people who knew those people, were quietly preparing for a world where accessing their own money might not be so simple. Bitcoin was just reflecting their urgency. By 2021 and 2022, this early move phenomenon was undeniable. As a wave of sanctions swept across Eurasia, Bitcoin's price in regional markets began to surge before any official freezes on central bank reserves were made public. Why? Because ordinary people were seeing the writing on the wall. Their international money transfers were slowing down. The channels they used to send money to family were tightening. The lines at the banks were getting longer. They didn't need a news anchor to tell them something was profoundly wrong. They acted, and Bitcoin moved first. This is when a handful of quantitative analysts started to experiment. They took their standard models and plugged Bitcoin in, not as another risky asset, but as a leading indicator for stress. What they found shook them. During times of geopolitical or monetary tension, Bitcoin was leading major currency pairs by hours, sometimes even days. It wasn't because Bitcoin was somehow smarter. It was because the people using it had fewer illusions. They understood a simple truth. When a bank starts whispering about liquidity problems, its customers act. When a government drafts capital controls, insiders reposition their assets. When sanctions are being prepared, the families who will be affected scramble to find a way out. Bitcoin is simply the only financial rail open and transparent enough to reflect these thousands of tiny, individual acts of financial self-preservation in real time. But the story gets even deeper. In certain crises, Bitcoin doesn't just lead the market, it completely decouples from it. When a nation's currency goes into a death spiral, you'll sometimes see the price of Bitcoin in that country soar, even if the global crypto market is flat or falling. This creates a regional premium, a price gap that shows you exactly where financial trust is evaporating. These premiums aren't about wild speculation. They're about survival. They are the financial footprints left by a population bracing for impact. And because Bitcoin is globally traded 24/7, these premiums act like a geopolitical seismograph, rattling long before the earthquake hits the mainstream financial world. Normally, the experts who study systemic risk look at things like swap spreads or interbank lending rates. But those are signals from the big players, the institutions. They tell you what the banks are worried about. They don't capture retail panic. They don't capture merchant panic. They don't capture the panic of a family trying to get money across a border. These are the signals that never show up on a Bloomberg terminal. Bitcoin does. The moment you grasp this, the entire narrative flips. Bitcoin isn't the asset that reacts to bad news. It's the channel through which the earliest warnings of that bad news leak out. It senses the fracture before the system is even willing to admit a crack has formed. Why? Because stress doesn't show up first in a trader's portfolio valuation. It shows up in people's lives. When a local bank starts delaying withdrawals, the global bond market doesn't care, but the people in that town do, and some of them turn to Bitcoin. When a government quietly drafts new currency restrictions, the stock market doesn't move, but the people who might be trapped do, and they turn to Bitcoin. This is where the story stops being just about cryptocurrency and starts being about the very structure of global finance. Our system was built on centralized bottlenecks: banks, clearinghouses, and government-controlled networks. Bitcoin sits completely outside of that design. It acts as a pressure release valve for every part of the world where trust is eroding faster than politicians can respond. So the real twist, the profound shift in this story, is this. Bitcoin's most important role in a crisis isn't reactive, it's anticipatory. It has become the migration path that capital takes when it senses the world is about to close a door. It's not just a form of escape liquidity for when things go wrong. If you know how to read the signals, you realize it has become the earliest, most honest alarm system the world has. An alarm it never intended to build, but one that may be more important than ever. Why do some people call Bitcoin a financial escape hatch? It's a question that goes much deeper than just price charts and speculation. To truly get it, you have to look at how money actually moves or fails to move when things get stressful. Modern financial crises don't usually start with a bang. They start quietly, with small frictions in the plumbing of the global financial system. These are problems most assets are too slow or too regulated to even notice. But Bitcoin, with its global reach and permissionless nature, reacts instantly. It responds to the fears of people who worry that the official channels might just fail them. To understand this, we need to peel back a few layers, starting with the most basic one: friction in the traditional banking system. When you send money internationally, it travels through what's called the correspondent banking system. Think of it like a network of highways for money. But here's the problem. According to the World Bank, the number of these highways has actually dropped by 20% in less than a decade. That means fewer paths for money to travel, more reliance on middlemen, and slower movement, especially during a shock. When a crisis hits, banks get nervous. They start to derisk. They might restrict cross-border transfers, tighten up compliance, or just delay payments to avoid getting caught in the crossfire. For example, when the pandemic first hit in 2020, SWIFT reported that payment delays shot up by over 30% in some regions. The system was getting clogged. And when the official rails slow to a crawl, what do people do? They look for an alternative that still works. Bitcoin, which settles globally in minutes, becomes that unintended release valve. But friction alone isn't the whole story. It's friction combined with fear that really explains Bitcoin's role. Take a look at countries where the local currency is collapsing. In Argentina, when inflation soared past 120% in 2023 and the government slapped on capital controls, what happened? Local Bitcoin trading volume on peer-to-peer platforms went through the roof. Or consider Nigeria, where chronic shortages of foreign currency destabilized their money, the naira. By 2022, Chainalysis reported the country had over $56 billion in crypto transaction value. This wasn't just gambling. It was driven by real people with real economic needs, trying to protect their savings. Bitcoin offers an escape because it doesn't need banks, clearinghouses, or official lines of credit. It operates on its own terms. This brings us to the second layer: settlement independence. Every traditional asset you own, from stocks to bonds to even the money in your bank, depends on an intermediary, a custodian, a broker, a clearinghouse. During a crisis, these intermediaries can become choke points, and the system becomes fragile. Think about it at the highest level. When Russia was sanctioned in 2022, over $300 billion of its foreign reserves were frozen. Instantly. This proved that even assets held by a sovereign nation depend on counterparties who can simply revoke access. Bitcoin has no such counterparty. No one can freeze your Bitcoin on the network itself. This independence makes it an incredibly valuable emergency channel. When anyone, an individual, a small business, a freelancer, an importer fears they might lose access to their money, Bitcoin becomes the path of least resistance. It's not about evading rules. It's about maintaining financial continuity when the official system starts to show cracks. And it's not just the wealthy who use this. In fact, it's often the opposite. Small-scale flows are what drive the early movements. Look at Lebanon's banking collapse. People were stuck, only allowed to withdraw tiny amounts of their own money. So peer-to-peer Bitcoin trading surged because it offered a way to move value that the banks no longer could. By 2023, the IMF noted that over 90% of bank deposits in Lebanon were still inaccessible. Bitcoin helped fill that massive void. We saw a similar story in Ukraine after the war started. Banking was disrupted, so civilians turn to Bitcoin and stable coins to send and receive money. In the first few months alone, crypto donations surpassed $100 million. This was proof that these new financial rails could handle real-world stress far beyond speculation. This leads us to the third layer, conversion pressure. How does a surge in demand in one country affect Bitcoin's global price? This is where it gets really interesting. Bitcoin is the same everywhere. A Bitcoin in Turkey is identical to a Bitcoin in Japan. But local conditions create what are called premiums. People in a crisis-hit country are often willing to pay more for a Bitcoin than people elsewhere. This premium shows just how desperate they are to convert their fragile local currency into a global asset. We've seen this pattern time and time again. There was the famous kimchi premium in South Korea in 2017, where Bitcoin sometimes traded at a 40% markup. We saw premiums in Nigeria and in Argentina during its hyperinflation spikes. These premiums exist because the official system restricts access to US dollars, but Bitcoin provides an open back door. When banks can't give you dollars and the black market is unreliable, Bitcoin becomes a synthetic way to get them. People buy Bitcoin with their local currency, move it across borders on the blockchain, and then sell it for dollars somewhere else. This isn't just speculation. It's a functional workaround for capital controls and collapsing currencies. And these premiums are a powerful signal. They often start to widen days before the official exchange rates or bond markets show the same level of stress. Bitcoin moves early because the people using it are forced to move early. Now for the fourth layer, where we see two different groups acting in opposite ways. During a crisis, big institutional players are usually stuck. They're bound by compliance and have to stick with their approved counterparties. They can't just jump into Bitcoin, but retail users and small businesses? They can and they do. This imbalance makes Bitcoin uniquely sensitive to the very first signs of a liquidity crisis. Remember the collapse of Silicon Valley Bank in 2023? In the days that followed, Bitcoin's price jumped nearly 20%. Not because the crypto market was suddenly healthy, but because confidence in the traditional banking system was shaken. On-chain data from Glassnode showed a huge surge in people moving their assets into self-custody off of exchanges. It was a flight to safety, a shift in trust away from institutions. While bank stocks were plummeting, Bitcoin was rallying. This showed it was acting as a safety valve for people worried about their deposits, not just another risky asset. This is what makes Bitcoin different. It doesn't just track value, it tracks the migration of trust. This brings us to the fifth and final layer, the unstoppable liquidity pathways. Bitcoin's network operates 24/7 everywhere, regardless of politics or borders. During the initial months of the Russia-Ukraine conflict, on-chain data showed a spike in Bitcoin transactions between $1,000 and $10,000. These weren't huge institutions. This was the signature of individuals and small businesses moving money. At the same time, peer-to-peer Bitcoin volume surged in Russia as ordinary citizens watched the ruble lose 40% of its value in weeks. On the other side, Ukrainian civilians and NGOs were using Bitcoin to get around a banking system that had been completely disrupted by war. These parallel flows revealed something profound. Bitcoin's role as escape liquidity doesn't come from it being unregulated. It comes from it being uninterruptible. Banks shut down in a war. Bitcoin doesn't. Correspondent banking networks freeze. Bitcoin doesn't. National borders close. Bitcoin doesn't. This unique property turns Bitcoin into a universal fallback system. It is a system that automatically absorbs financial pressure every single time the world is official. Liquidity infrastructure starts to fail. Let's look at the sixth layer, Bitcoin's escape liquidity function. This becomes crystal clear when you compare its settlement properties to traditional systems. Bitcoin transactions finalize in about 10 minutes on average with no intermediaries. Even when the network is congested, settlement times are way faster than a cross-border bank wire, which can take 1 to 5 business days. This timing is critical during a crisis. A few hours can mean the difference between protecting your life savings and losing everything. Think back to the 2023 Turkish lira volatility. Local Bitcoin volumes on peer-to-peer platforms shot up as people sought faster settlement than banks could offer. In Argentina, during repeated currency devaluations, Bitcoin's speed allowed users to convert unstable pesos into offshore assets before the daily devaluation cycles wiped out 10 to 20% of their value. Bitcoin settlement is also censorship resistant. In traditional finance, transactions can be frozen, reversed, or delayed. But Bitcoin's base layer has no such administrative intervention. It's the only liquidity pathway that stays open even when governments impose restrictions. This isn't about ideology. It's mechanical. Bitcoin's rules enforce finality no matter the political climate. During sanctions expansions in 2022, blockchain analysts saw a significant rise in activity from regions indirectly affected by financial blockades. It wasn't just sanctioned entities. It was civilians experiencing remittance slowdowns and account freezes. Bitcoin unintentionally became a tool for continuity. The seventh layer is the arbitrage architecture, the invisible machinery connecting local Bitcoin markets to global ones. Arbitrageurs are key to smoothing out Bitcoin's global price. But during crises, capital controls disrupt this process, creating regional price differences that show exactly where the stress is most acute. For example, when China tightened capital controls between 2016 and 2017, the inability to arbitrage effectively led to persistent price premiums in mainland markets. Similarly, during Nigeria's naira instability, arbitrage constraints caused consistent Bitcoin premiums, reflecting a high demand for US dollar substitutes. These premiums aren't market inefficiencies. They are financial X-rays exposing hidden fractures. When people lose access to foreign currency, they turn to Bitcoin. When arbitrageurs can't equalize prices due to restrictions, that stress becomes measurable. Bitcoin's global fungibility ensures these signals spread across exchanges, allowing analysts to spot emerging liquidity risks by monitoring these price dislocations. This is completely different from traditional markets, where derivatives often mask underlying stress. Bitcoin's transparency exposes tension in real time because everyone from retail investors to large corporations shares the same global rail. This paradoxically makes Bitcoin more efficient at revealing localized panic than institutional markets, which are slower and more insulated. Now for the eighth layer, the psychological incentive structure. This is the unseen force that enables Bitcoin to act as escape liquidity even before a technical breakdown occurs. Humans react to the perception of risk far faster than institutions react to the presence of risk. When people hear rumors of capital controls, see long lines at banks, or feel their currency depreciating, they act preemptively. This creates early flows into Bitcoin driven by fear, not valuation. Behavioral economists often overlook the power of anticipation, but history shows that populations in unstable countries move their assets early, while those in developed markets wait for official confirmation. This asymmetry is why Bitcoin becomes predictive. Populations on the periphery of the global system feel the stress first, and their actions leave a footprint on Bitcoin long before institutional markets react. During the early stages of the Lebanese banking collapse, citizens shifted into Bitcoin well before major rating agencies downgraded the country's banking sector. As Argentina's inflation worsened, Bitcoin volumes climbed sharply before the official exchange rates were adjusted. In Turkey, Bitcoin usage surged even when official inflation statistics were underreporting the currency's erosion. These early signals are traces of a truth the financial system prefers to ignore. The earliest warnings come from the people with the fewest buffers, not the people with the most data. The ninth layer is the infrastructure that supports Bitcoin's role as escape liquidity. This includes exchanges, peer-to-peer platforms, self-custody wallets, payment processors, and the Lightning Network. Contrary to popular belief, Bitcoin's escape liquidity function doesn't rely solely on centralized exchanges. In regions with strict capital controls, peer-to-peer marketplaces become the main pathway. For instance, Paxful reported billions in annual volume from African markets before it shut down, showing how informal economies create parallel access channels. During the early days of the war in Ukraine, both centralized and peer-to-peer platforms supported critical civilian flows. NGOs even used Bitcoin for donations because the banking infrastructure was disrupted. The Lightning Network adds another layer, enabling low-fee, near-instant settlement even during peak congestion. This allows communities to route microtransactions outside of formal channels. As global conflicts and sanctions reshape trade routes, Bitcoin's borderless infrastructure becomes more useful, not because people prefer it ideologically, but because the alternatives are failing. In Argentina, we saw the adoption of Bitcoin-based payment apps that let merchants accept BTC or stablecoins, providing stability when the peso was rapidly losing value. Nigeria's crypto adoption grew for similar reasons. FX shortages and capital restrictions pushed citizens to use Bitcoin-based transfer systems. All this infrastructure expands the pathways through which Bitcoin can absorb stress. Finally, the 10th and most important layer, how Bitcoin becomes a systemic indicator. When global stress emerges, Bitcoin's order books reveal micro-shifts that are invisible to traditional markets. During regional banking crises, Bitcoin liquidity clusters toward smaller transaction sizes as retail users seek safety. During sanctions, the patterns shift toward cross-border transfers. Analysts who only look at price miss this deeper layer. Address activity, exchange inflows and outflows, and changes in self-custody behavior all form a mosaic that captures the erosion of trust in real time. When the U.S. regional bank crisis hit in 2023, exchange outflows spiked to multi-year highs. This indicated a massive migration toward self-custody, a behavioral shift. You just don't see in stocks or foreign exchange markets because they don't have a self-custody option. Bitcoin exposes this trust migration because its architecture allows users to abandon intermediaries instantly. In traditional finance, leaving the system means selling assets and waiting for a bank settlement, which might be impaired during a crisis. Bitcoin compresses the timeline of trust erosion, turning psychological stress into measurable liquidity patterns faster than any other asset. When you combine these 10 layers, friction, independence, conversion pressure, asymmetric behavior, global settlement, arbitrage, psychological anticipation, infrastructure resilience, and transparency, Bitcoin becomes a fully functional escape liquidity mechanism. It absorbs shocks that traditional markets can't. It doesn't replace the global financial system. It shadows it. It doesn't operate as a safe haven. It operates as a safe exit. And because it reacts not to valuations but to people escaping vulnerable systems, it becomes the earliest and most honest indicator of stress in a world increasingly defined by digital choke points and fragile institutions. Bitcoin's escape liquidity architecture isn't a theory or an ideology. It is an emergent property of a world where money must cross borders even when banks cannot, where capital must move even when institutions freeze, and where trust must migrate even when the official narrative insists everything is fine. In the end, the truth about Bitcoin's role as escape liquidity is quieter, heavier, and more unsettling than any headline you'll read about price swings or speculative manias. Because beneath all the noise of modern markets lies a simple reality that most institutions refuse to acknowledge. Every financial system is only stable until it isn't. Every currency is only trusted until it breaks. And every official path for your money is only reliable until the moment a government decides it no longer has to be. And when those moments arrive without warning, without ceremony, without any regard for the people caught in the middle, Bitcoin becomes the channel through which fear migrates into action. But the real warning here isn't about Bitcoin at all. It's about what its behavior reveals. When Bitcoin rises during sanctions, it's not celebrating chaos, it is mapping it. When it climbs during bank failures, it's not speculating on collapse, it is absorbing the uncertainty that institutions cannot contain. When it moves ahead of capital controls, it's not forecasting policy, it is reacting to whispers spreading through households long before they ever reach the trading floors. And when Bitcoin surges in regions where trust evaporates overnight, it's not acting as digital gold. It's acting as the final functioning road out of a city whose gates are slowly closing. The entire global financial system has always depended on one core illusion, that access to your money will always be there. But access is the first thing to disappear during a crisis. As history shows us time and time again, from Cyprus to Lebanon, from Argentina to Nigeria, from Ukraine to every sanctioned corridor, systems fail unevenly. First gradually, then suddenly. And each time, Bitcoin's rails remain open. Indifferent to politics, immune to borders, unbothered by capital controls, and unshaken by bank closures. This absolute reliability is what makes Bitcoin so dangerous to ignore. Because if you watch it closely enough, you stop seeing speculation and you start seeing signals. You see the exact moment people begin to doubt their banks. You see the moment remittances slow to a crawl. You see the moment offshore liquidity tightens. You see the moment governments start testing new restrictions on their citizens. And you see the moment global markets begin to fracture just beneath the surface. Most people wait for official confirmation, an IMF report, a credit downgrade, a bond market blowout, or a central bank press conference. But by the time those events arrive, the fracture is already in motion. The damage is done. Bitcoin saw it first because people felt it first. And this is the quiet, uncomfortable truth. Crises are not born in institutions. They are born in households, in small businesses, in cross-border families, in the daily rhythms of people who can no longer rely on the systems that once felt so permanent. Bitcoin registers their decisions long before the rest of the world understands their meaning. So the warning, ultimately, is not about Bitcoin's future price or its ideological promise. It is about the world that keeps forcing people to use it. A world where trust is eroding faster than our institutions can ever hope to rebuild it. A world where geopolitical fragmentation is pushing money into smaller, more fragile channels. A world where governments increasingly turn financial access into a tool of policy and control. A world where the plumbing beneath our global markets is far more brittle than anyone wants to admit. In a world like that, Bitcoin will continue to flicker in the corner of the system. Sometimes quietly, sometimes violently, but always honestly. It will remain the place where capital hides when uncertainty becomes unbearable, where movement continues when borders close, and where options survive when banks fail. And if you follow that flicker long enough, you begin to understand that Bitcoin is not a rebellion against the system. It is a mirror reflecting the system's own weaknesses. A mirror the world would much rather not look into. But those who ignore it will always be late. And those who learn to read it will see the fracture long before the lights go out. This is the file you were not meant to open. But now that you have, you carry a question with you. Not whether Bitcoin will rise or fall, but what it will reveal next, about the system, about trust, and about the world that built an exit it never ever expected to need.